There's this invisible force at work in our economy, quietly reshaping pretty much everything around us. It's not usually the big, flashy headline, but its influence, it's absolutely undeniable. We're talking about the quiet power of high interest rates.
Let's be honest. When do you really think about interest rates? Probably when you're looking at a mortgage, or maybe when you see that credit card bill, right? They feel kind of personal, like they're just about that one transaction. But that is just the tiniest tip of the iceberg. The reality is so much bigger, and it affects every single one of us.
Because what's really happening is that interest rates are acting like this invisible hand, steering the flow of money through our entire society. They quietly and very systematically decide who has the opportunity to build wealth and who ends up losing their financial freedom. This goes way beyond just the cost of a loan. It's a fundamental shift in economic power. So, how does this actually work? To really get a handle on the huge changes that are happening, we've got to start with the most basic idea of all, the price of money itself.
At its core, it's actually this simple. An interest rate is the price of money. Seriously, think about it. Just like the price of gas or food. When that price goes way up, what do? We change our behavior, right? We drive less, we look for deals. Well, the exact same thing is true for money, and that's the key to understanding everything else.
For what felt like forever, most of us were living in a world of super low rates. Money was cheap, so borrowing was easy, and it was happening everywhere, for everything. But now, we're in a high-rate world. Money's expensive, and that means borrowing becomes selective, way more cautious. And this one single change is what sets off this massive chain reaction. And this is where we get to see the ripple effect in action. I want you to imagine a rate hike as a single stone dropped into a calm pond. Now let's follow those waves as they spread out across the entire economy. So that first ripple, it hits us right at home, in our wallets. All of a sudden, mortgage payments are higher. Car loans cost more. That credit card debt feels like a much heavier weight. And you know that easy option to just refinance into a cheaper loan? Poof, it's gone. Our financial breathing room just gets smaller and smaller. But here's the thing. This ripple doesn't hit everybody in the same way. Not at all. If you don't have a lot of debt, you might barely even feel it. But if you're highly leveraged, if you've got a lot of loans, that lack of flexibility becomes a really serious problem. See, high rates don't necessarily create financial stress out of nowhere. They just amplify what's already there.
Okay, the next ripple spreads out to the housing market, and this is where things get really fascinating. At first, it's what you'd expect. Mortgage rates climb, so fewer people can afford to buy a house. Affordability plummets, and demand cools off. So far, no surprises, right?
But here's the wild twist. All those people who already own homes, the ones who locked in those amazing, ultra-low mortgage rates a few years back, they're basically trapped in golden handcuffs. I mean, why in the world would they sell their house and trade a 3% loan for a 7% one? They won't, so they stay put. And that means the supply of homes for sale just dries up. So instead of a big market crash, you get a market freeze. Things just stop.
And that feeling of caution doesn't just stay in the housing market. It creates a third ripple that hits businesses. When the cost of borrowing money goes up, a lot of projects just don't make financial sense anymore. That big expansion plan, it gets put on hold. Hiring slows way down, and the overall appetite for taking big risks, it just shrinks. The economy doesn't grind to a halt, but it definitely becomes a lot more hesitant.
We see a really similar shift in the fourth ripple, the financial markets. For the first time in a very long time, you can actually get a pretty good return on super safe stuff, like government bonds. And when that happens, suddenly gambling on risky, speculative stocks seems a whole lot less attractive. The result? You see money literally flowing away from that high-risk speculation and moving toward predictable, stable returns.
And then there's the final, massive ripple, the one that hits governments. It works just like it does for a household. The interest payments on the national debt shoot up, and that eats up a bigger and bigger slice of the national budget, which leaves less money for everything else. It makes every single policy choice that much harder. The margin for error for everyone just got a whole lot smaller. So after all these ripples have spread out, what are we left with? Well, we're looking at a totally new economic landscape. This is the reckoning. It's the point where we can finally see clearly who is set up to win in this new environment and who is really set to lose.
Now let's be clear. This isn't about good guys and bad guys. It's not a moral judgment. It's just about incentives. On one side, you have the people who benefit, savers who are finally earning more interest, businesses with clean balance sheets, and really anyone with cash who can afford to just be patient. And on the other side, well, that's where you find those who struggle. Households carrying a lot of debt, businesses that were built on the idea of cheap credit, and any system that depended on being able to constantly refinance.
All of this brings us to our final, and I think most important, idea. What's happening isn't just a simple economic slowdown. It's much more profound. You can think of it as the great financial filter. What does a filter do? It separates things. And high rates do exactly that. They fundamentally reshape our behavior with money. They actively discourage taking on too much debt. They reward having cash on hand, what the experts call liquidity. And maybe most importantly, they shift economic power to those people and companies who have the patience and the resources to just wait for the right opportunity to come along.
So, here's the crucial thing to walk away with. High interest rates are not just some boring policy knob that a central bank turns to fight inflation. They are a filter, a powerful one. They are sorting out which financial habits, which business models, and which investments are truly strong enough to survive and even thrive in this new, more disciplined world. And the big question for all of us now is, what gets through?